Okay, we're going to start chapter 3 in the financial accounting Kimmel book. Quite honestly, this is probably the most important chapter. It is the most important chapter in financial accounting because this is where we really learn how to prepare journal entries and ultimately post to T accounts. So if you don't get this chapter, you're going to have a great deal of difficulty with the balance of this course. So this is the foundation. This is the fundamentals of debits and credits and journal entries. So let me share my screen with you so we can begin this PowerPoint. So as I mentioned, we're going to share the screen, and we'll start this PowerPoint presentation, which is, as I mentioned, very difficult material, and it's crucial that you get a solid foundation of this material. So, accounting tools for business decision making, Chapter 3, the accounting information system. So here is the substantial learning objectives of this chapter. Analyze the effect of business transactions on the accounting equation. And let's remember that every transaction in business ultimately results in a journal entry. That's the key here. Learning objective 2, explain how accounts, debits, and credits are used to record business transactions. Number 3, indicate how a journal is used in the recording process. Explain how a ledger and posting help in the recording process. And then ultimately, we're going to prepare a trial balance. Analyze the effect of business transactions on the basic accounting equation. So using the accounting equation to analyze transactions, accounting information system, a system of collecting transaction data, processing transaction data, and commuting that financial information to decision makers. So the communicating is essentially the preparation of the financial statements, income statements, statement of retained earnings, balance sheet, and statement of cash flows, which is used to inform investors, creditors, users of the financial statements on how the company has performed. The accounting information system, you can see, is quite complex. Accounting information systems rely on a process referred to as the accounting cycle. And yes, it's true that most businesses use computerized accounting systems, but the computer is simply a tool to make it more efficient and to streamline the process. What we're going to do in this class is we're going to do it with pencil and paper, and we're going to be drafting journal entries and going through the entire accounting cycle manually. In order for you to fully understand what's going on, we do it manually. Again, the computer streamlines it, saves time, but unless you know what's going on, the computer is meaningless. You use the phrase garbage in, garbage out. So here you see all of the steps that we're going to go through in terms of the accounting cycle. First part we're going to talk about is analyzing the business transactions. What is a transaction? Transactions are economic events that require recording in the financial statements. Not all activities in business require transactions. Assets, liabilities, or stockholders' equity items change as a result of an economic event, have a dual effect on the accounting equation. We're going to see what that means. Transaction identification process. Are the following events recorded in the accounting records? So the event, the first one is we purchase a computer. So the question is the financial position of the company changed? So if a company purchases a computer, yes, something happens. And we'll understand that transaction a little bit later. So there is an effect on the company's assets when they purchase a computer. Travel, discuss a guided trip options with a potential customer. So yes, it's something that's going on in business, but the mere discussion does not have an impact on the assets and liabilities of the company. And thirdly, paying the rent. Again, a business transaction where a company is paying the rent of the business. Does it affect the assets of the company? Most definitely. The process of identifying the specific effects of economic events on the accounting equation. Again, here's the accounting equation. Assets equal liabilities plus stockholders' equity. And we have seen that. We have seen that when we were preparing the balance sheet. Assets equaled liabilities plus equity. Now, the key here is this equation always has to stay in balance, okay? If it's not in balance, you did something wrong. The accounting equation must always balance. Each transaction has a dual effect on the equation. If an asset is increased, there must be a corresponding decrease in another asset, or an increase in a specific liability, or increase in stockholders' equity. Here's an expanded equation. Assets equal liabilities plus stockholders' equity. And stockholders' equity is made up of two big things: common stock and retained earnings. In retained earnings, think back to the statement of retained earnings: revenues minus expenses minus dividends. Let's analyze some transactions. Event number one. Investment of cash by stockholders. On October 1, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. So the key before you start putting pencil to paper is to understand the transaction. And here there's an exchange. An individual has given $10,000 of cash to this corporation and received a stock certificate. So what happens to this corporation? The Sierra Corporation, they receive cash, so cash goes up. An asset is increased by $10,000. And it's also an increase in the common stock. So on the left-hand side of the equation, assets, $10,000 goes up. And on the right-hand side of the equation, common stock also goes up. The equation is in balance. Event number two. Note issued in exchange for cash. On October 1, Sierra borrowed $5,000 from Castle Bank by signing a 3-month, 12% $5,000 note payable. So what is the transaction? Sierra received $5,000 in cash and did what? Agreed to an obligation to pay $5,000, a liability. So on the left-hand side of the equation, there's an increase of $5,000. And on the right-hand side of the equation, there's also an increase in a liability of $5,000. The equation continues to be in balance. Event number three, purchase of equipment for cash. On October 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. Purchased equipment by paying cash. Cash and equipment are both assets. So what happened? They paid cash, so cash went down. But they also received a piece of equipment, so the equipment goes up. So this is a transaction that occurs both on the left-hand side of the equation. Cash went down, equipment went up. The equation is still in balance, right? Receipt of cash in advance from a customer. On October 2nd, Sierra received $1,200 cash in advance from Arnox, a client. Well, cash in advance means they were paid up front for services to be performed. So they received cash. Cash goes up on the left-hand side of the equation by $1,200. On the right-hand side, they have an obligation to perform. It's a liability. Increase of $1,200. Again, the equation is in balance. Event 5, services performed For cash, Sierra received $10,000 in cash from Copa Company for guide services performed. Services performed, that's revenue. Revenue goes up. Revenue is a component of stockholders' equity. So on the right-hand side of the equation, there's an increase of $10,000, increase in revenue. And on the left-hand side of the equation, they received $10,000 cash. Cash goes up, revenue goes up, equation is in balance. Event 6, payment of rent. On October 3rd, Sierra Corporation paid its office rent for the month of October in cash, $900. So they paid in cash. Cash went down. They also have an expense because office rent expense went up. Expenses are a negative impact on retained earnings. So cash went down on the left. Equity, retained earnings, went down on the right. The equation is in balance. Event number 7, purchase of insurance policy for cash. On October 4th, Sierra paid $600 for a 1-year insurance policy that will expire next year on September 30th. So this one's a little tricky. Let's deal with the cash part. They paid cash. Cash is an asset. It's a subtraction. Cash went down. But you would ordinarily think that insurance is an expense, but they prepaid this expense. They paid it in advance. Cannot recognize the expense until it expires. Has not expired yet. It's considered an asset. So prepaid insurance goes up. Cash goes down. Prepaid insurance goes up. The equation is in balance. Then 6, purchase of supplies on account. On October 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. Sierra purchased an estimated 3 months of supplies on account. On account. They didn't use cash. They paid it on account, means they have a promise to pay it in the future. It's a liability. So on the right-hand side of the equation, you see accounts payable, promise to pay goes up. Obligations to pay goes up on the right-hand side. The left-hand side of the equation is they purchase supplies. It's an asset until it expires. It's an asset until they use it. So supplies goes up as an asset. On the left-hand side of the equation, obligation to pay goes up. The accounting equation is in balance. Event number 9, hiring of new employees. On October 9th, Sierra hired 4 new employees to begin work on October 15th. The mere fact that they hired employees is not a transaction that affects assets, liabilities, or equity. No transaction has occurred. Payment of a dividend. On October 20th, Sierra paid a $500 dividend. Paid, cash goes down. An asset goes down. On the left-hand side of the equation, minus 500. Dividends, as you remember from the statement of retained earnings, is a reduction of retained earnings. It drops it. It brings it down. If it drops retained earnings, it drops equity. Negative impact, minus on both sides of the equation. Equation is in balance. Event number 11, payment of cash for employee salaries. Employees have worked 2 weeks earning $4,000 in salaries, which were paid on October 26th. So they paid their employees $4,000. Cash goes down on the left-hand side of the equation. Salaries expense. Expense is a reduction of retained earnings. It's a reduction of equity. So it's a minus on the right-hand side of the equation. Equation continues to be in balance. A tabular analysis of the transactions for the month of August is shown below. Describe each transaction. So transaction number 1, cash goes up, common stock also goes up. The company issued shares of stock for $25,000 cash. Transaction number 2, equipment goes up and a liability goes up. Company purchased $7,000 of equipment on account, did not pay for them, obligation to pay. Transaction number 3, cash goes up, revenue goes up. Company received $8,000 cash in exchange for services performed. And number 4, cash goes down, an expense is increased, it's rent expense. So remember, an expense reduces equity. That's why it's a minus over there. Company paid $850 for this month's rent. Learning objective 2, explain how accounts, debits, and credits are used to record business transactions. Here it is. This is the most difficult part. It is the most important material of this course. If you don't get this, you're going to have difficulty. Accounts, debits, and credits. An account is an individual accounting record of increases and decreases in a specific asset, liability, stockholders' equity, revenue, or expense item. A T account consists of a title of the account, cash, equipment, inventory. A left or debit side, the left side of the T account is always the debit. A right or a credit side, the right side is also the credit, is always the credit. This is what the T account looks like. If debits are greater than credits, the account will have a debit balance. So again, you can see the T account has a name on the top of it. The left side is always the debit. The right side is always the credit. And we will be posting transactions. If credits are greater than debits, the account will have a credit balance. But we'll see that later. Debit and credit procedures. Each transaction must affect 2 or more accounts, at least one debit and at least one credit. Equality of debits and credits is the basis for the double entry accounting system. Debits must always equal credits. That's an absolute key. And again, it is part of the accounting equation, where the assets equal liabilities plus stockholders' equity always needs to be in balance. So that third bullet is crucially important. Debits must equal credits. Procedures for assets and liabilities. Asset accounts, debits should exceed credits. Liability accounts, credits should exceed debits. So this again is important because on assets, you use a debit to increase it. You're always going to increase an asset with a debit, and an asset has a normal debit balance. To decrease an asset, you will credit that account. Liabilities, just the opposite. In order to increase an obligation to pay, it's going to be a credit. To decrease a liability, it's going to be a debit. Here's a hint for you. The normal balance is the side where increases in the account are recorded. Procedures for stockholders' equity. Investments by stockholders and revenues earned increase stockholders' equity accounts as credits. So let's look at that. The common stock and retained earnings, you increase them with credits. So again, when stockholders invest cash in the business, that's going to be a credit. You're going to increase the common stock account. And when you get revenues, revenues are going to increase retained earnings. So revenues are always a credit. Dividends and expenses decrease stockholders' equity. It's always a debit. So when you increase an expense, it's going to be a debit. And when you pay dividends, it's also a debit because those things decrease retained earnings. Revenues increase stockholders' equity. We just talked about that. Expenses decrease stockholders' equity. The effect on revenue and expense accounts is the same as their respective effects on stockholders' equity. So just key is to remember those first two bullets. Revenues increase stockholders' equity, so it's always going to be a credit. Revenues are always a credit. Expenses decrease stockholders' equity. It's always going to be a debit. Investor insights of the Chicago Cubs. The Chicago Cubs baseball team has these major revenue and expense accounts. Admissions, ticket sales, concessions, television and radio, and advertising. Those are the revenue accounts. And when they pay them, they're going to credit revenues. They're going to have expenses. Increase in expense is a debit. Salaries, travel, and maintenance. Do you think the Chicago Bears football team would be likely to have the same major revenue and expense accounts as the Cubs? Of course. So financial statement relationships. We've seen this. First one is the income statement, where take revenues less expenses equals net income. That net income number travels over to the statement of retained earnings. You end up with the ending retained earnings balance, and that transfers over to the balance sheet account. We've seen that already. Summary of debit and credit rules. Relationship among the assets, liabilities, and stockholders' equity. The basic equation, as we talked about, assets equal liabilities plus stockholders' equity. And here we see the expanded basic equation. And again, this is important. Assets are increased with a debit. Assets are decreased with a credit. On the liability side, it's just the opposite, isn't it? Liabilities increase with a credit, are decreased with a debit. Let's move over to the right-hand side. We see revenues. Revenues always go up with a credit. Expenses always go up with a debit. The equation must be in balance after every transaction. For every dollar of debits, there must be the same dollar amount of credits. Here's a question for you. Debits do what? Increase both assets and liabilities? No. Debits decrease both assets and liabilities? No. Debits increase assets and decrease liabilities. Correct, right? Next question. Accounts that normally have debit balances. Debit balances. Assets, expenses, and revenues? No. Revenues have a normal credit balance. Assets, expenses, and equity? No. Equity has a normal credit balance. Assets, liabilities, and dividends? No, because liabilities have a normal credit balance. Assets, dividends, and expenses is the answer. They all have a normal debit balance. Learning objective number 3, indicate how a journal is used in the recording process. The recording process, steps to record. Analyze each transaction in terms of its effect on the account. So which accounts are affected? Number 2, enter the transaction information in a journal. And number 3, transfer the journal information to the appropriate accounts in the ledger. So let's look at the first transaction here. So this is Superior Equipment Sales, bill to Sierra Corporation, and it says purchase of equipment for $5,000. We're going to have a journal entry, and then we're going to post to the T account. So we're going to understand the transaction, we're going to prepare a journal entry, and then we're going to post it to the T account. The transactions are recorded in chronological order in a journal before they are transferred to the accounts. The journal contributes to the recording process because it discloses the complete effect of a transaction, provides a chronological record, and helps prevent or locate errors later on. Journalizing, the process of entering transaction data in the journal. Illustration, presented below is the information related to Sierra Corporation. October 1, Sierra issued common stock in exchange for $10,000 stock. Another transaction, Sierra borrowed $5,000 by borrowing a note. And then on October 2nd, Sierra purchased equipment for $5,000. We want to journalize these transactions. So here's the first one. Sierra issued common stock in exchange for $10,000 cash. And we saw this one earlier, where cash goes up and common stock goes up. So let's remember to prepare our journal entry, what happens? So cash is affected, that's the first account. What happens to cash? Cash goes up. How do I increase cash? With a debit. What else happened? Common stock went up. To increase common stock, that's a credit. There's your journal entry. Debit, cash, credit, common stock. Debits equal credits. Accounting equation is in balance. October 1, Sierra borrowed $5,000 by signing a note. That's the transaction. Which accounts are affected? Cash and note payable. Cash goes up, that's a debit. Notes payable also goes up, you increase that with a credit. There's your journal entry. Debit cash, $5,000. Credit notes payable, $5,000. Debits equal credits. The accounting equation is in balance. All is good. Third transaction, Sierra purchased equipment for $5,000. Which accounts are affected? Cash and equipment, both assets. Purchased equipment for $5,000. Cash went down. You decrease a debit, you decrease an asset with a credit. Equipment is also an asset that went up. Increase an asset with a debit. Here's your journal entry. Always put the debits before the credits. As a general practice, put the debits before the credits. Equipment goes up by $5,000, debit. Cash, another asset, goes down, it's a credit. Debits equal my credits. So here's my general journal, which is a listing of all my journal entries of the ones we just prepared. Again, your debits always equal your credits. Following events occurred during the first month of business of Hair It Is, Inc., Kate Brown's Beauty Salon. Issued common stock to shareholders in exchange for $20,000 cash. Purchased $4,800 of equipment on account to be paid in 30 days. Interviewed 3 people for the position of stylist. The 3 activities are recorded as presented on the next slide. Issued common stock in exchange for $20,000 cash. Cash goes up, it's a debit. Common stock goes up, it's a credit. Purchased $4,800 of equipment on account to be paid in the future. Equipment is affected in some type of liability. Equipment is an asset, you increase it with a debit. Accounts payable, a liability, also goes up for $4,800. And that third transaction wasn't really a transaction because it doesn't affect assets, liabilities, or equity. No journal entry. Learning objective 4. Explain how a ledger and posting help in the recording process. So we just learned how to prepare journal entries. Now we know how to post them. So the ledger is comprised of an entire group of accounts maintained by a company. Some typical asset accounts are cash, supplies, land, equipment, can also be inventory, prepaid expenses, accounts receivable. Some liability accounts, interest payable, salaries payable, accounts payable, notes payable. And here are my equity accounts, various expenses, revenue accounts, dividends, common stock. Accounts in red are used in this chapter. So these are the ones that we're going to use, but there are still other ones out there. Posting. Posting involves these steps. In the ledger, enter in the appropriate columns of the debited accounts, the date and debit amount is shown in the journal. In the ledger, enter the appropriate columns of the credited accounts, the dates and credit amount shown. So you've got your journal entries, and we're essentially going to post to the T accounts. Let's take a look. Posting normally occurs before journalizing? No. Posting transfers ledger transaction journal to the transfers ledger transaction data to the journal? No. Is an optional step in the recording process? No. Transfers journal entries to the ledger accounts? That's the answer. Journalize, then post. Recording process. Steps in the recording. Determine what type of account is involved. Determine what items increased or decreased and by how much. Translate the increases and decreases into debits and credits. We sort of did a little bit of this already. So here is a transaction. Again, we've seen this transaction before. We're just expanding on it, right? Stockholders invest $10,000 in exchange for common stock. And we saw the equation, how it worked. Cash goes up, common stock goes up. In the middle here where it says debit and credit analysis, we prepared this journal entry, right? Debit cash for $10,000, credit common stock. The new piece is the posting to the ledger account at the very bottom. You have a T account. The debit is always on the left, the credit is always on the right. For the cash T account, it's a debit to cash, an increase in cash. We posted the debit for $10,000. The common stock is a credit. We posted to the right-hand side of the T account. Second transaction, borrows $5,000 by signing a note. Obligation to pay. We saw the journal entry here. Debit cash, credit notes payable. On the very bottom of the screen, you can see the T account for cash. There's going to be multiple transactions in that one account. Cash goes up, it's a debit. Debit $5,000. Credit this other account, note payable. Obligation goes up, credit $5,000. On October 2nd, Sierra used $5,000 cash to purchase equipment. Let's look at the journal entry. We recorded the increase in the asset, equipment $5,000, and the decrease in cash, credit $5,000. Bottom of the screen, you can see the cash T account again. Again, another transaction going through that one account. You got the credit to cash, and then the equipment account goes up, it's a debit. Event 4, Sierra received $1,200 cash advance from Knox, a client for guide services for multi-day trips that are expected to be completed in the future. Let's look at the journal entry. Debit cash, because they received cash, cash goes up, $1,200. Credit a liability, services to be performed. It's a liability. Credit $1,200. T accounts on the very bottom. You can see that cash account's got a lot of activity. Debit it for $1,200. Credit the unearned service revenue. Event 5. Sierra received $10,000 in cash for guide services performed. Received cash, and it's revenue. Have your journal entry we've seen before. Debit cash because cash goes up. Credit revenue. Revenue goes up. You increase revenue with a credit. The bottom of the screen, you can see your T account for cash. You've got $10,000 debit, and then service revenue's got a credit for $10,000. Event number 6, Sierra paid office rent in cash for $900. Your journal entry, debit rent expense for $900, credit cash for $900. You can see how they posted it to the T accounts. a credit to cash, a debit to rent expense. Sierra paid $600 for a one-year insurance policy that will expire on October 30th. And we saw that transaction before because it's not an expense until it's used. It has not been used yet. So we debit an asset called prepaid insurance, and we're going to credit cash because they paid cash. You can see where we post it to the account, the cash. You credit cash for $600 on the right-hand side of that T account. And you get that asset called prepaid insurance. I'm going to debit that account. Event number 8, Sierra purchased an estimated 3 months of supplies on account from a supply company for $2,500. It's not a supplies expense yet because it has not been used. If it has not been used, it's an asset. That's why we debited supplies, which is an asset account. And we're crediting the promise to pay the accounts payable. T accounts on the bottom. Debit the asset account called supplies. Credit the liability, promise to pay $2,500. On October 9th, Sierra hired 4 employees to begin work on October 15th. Each employee will receive a weekly salary. We determined because they hired them, it's a business event, but it is not a transaction because it does not affect a liability, asset, or equity account yet. They've only hired them. No journal entry required. On October 20th, Sierra paid $500 cash dividend to stockholders. They increased the dividend, they decreased cash. You increase dividends with a debit. Debits reduce equity. Cash went down, credit cash. You see the T accounts on the very bottom, credit to the cash account, debit to dividends. Cash account's got a lot of activity in it. It's just one account. Post it to one T account. On October 26th, Sierra paid employees salaries of $4,000 in cash. Now you have an expense. Salaries and wage expense, you increase an expense with a debit for $4,000. Used cash. Cash is an asset, you decrease it with a credit. There's your journal entry, and that's where they posted it. So here is my general journal. A general journal is a listing of all my journal entries, all the ones we just did. Here are all the T accounts that we used. Cash has got the big one for both transactions. So we posted all of those journal entries to these T accounts. And more importantly, when we're done at the end of the month, we're going to take a summary of those amounts. You can look at the cash account. It's a bunch of debits, a bunch of credits. You want to calculate the net amount in each account. And you can see in the cash account, there is a net debit balance. The supplies account only has one transaction, a debit for $2,500. The balance is a net debit $2,500. The same with all the other accounts. Prepare journal entries, post to T accounts. Posting. Selected transactions from the Journal of Vital during the first month of operations are presented below. Post these transactions to the T accounts. So they got the journal entries, and they're just going to post them, right? And you can see that's what they did. Took the journal entries and they simply posted each one of them. We'll talk about the first one, okay? Cash, debit cash, credit common stock. You can see they debited the cash on July 1, credited common stock. It's a debit and a credit. Got to post both pieces. Prepare the trial balance. So the trial balance is simply a listing of all of the debits and credits from your T accounts. So you took the balances in your T accounts, you calculated the net balance, and now all we're going to do is write them down in tabular form. A trial balance, a list of accounts and their balances at a given time. Accounts are listed in the order in which they appear in the ledger. Assets, liabilities, stockholders' equity, revenues, and expenses. Purpose is to prove that debits equal your credits. We're going to see how that is. We're going to list all the debits. We're going to list all the credits. They should equal each other. May uncover errors in journalizing and posting, useful in the preparation of financial statements. This is the trial balance for Sierra Corporation. And all they did here is took all those T accounts and they transferred the net balance into this account. For example, let's look at cash. Cash, a debit balance of 15.2. I'm going to go back to the screen where we had the trial balance. I mean, the posting. See the T accounts? Cash, $15,200 debit. Let's also look at supplies. Net debit, $2,500. See supplies, $2,500. So all they did is they took a net balance in each one of those T accounts and then transferred it to the trial balance. Wrote the account name and then put it, if it's a debit, they put it in that debit column, a credit in a credit column. You do it for all the accounts and look at the very bottom. Got total debits of $28,700, total credits of $28,700. Debits equal credits. Remember we said at the beginning of this lecture, that's one of the most important things, that your debits must equal your credits. Limitations of the trial balance. The trial balance may balance even, a trial balance may balance even when a transaction is not journalized. A correct journal entry is not posted. A journal entry is posted twice. Incorrect accounts used in journalizing or posting. Offsetting errors. So just because your debits equal your credits doesn't mean that you got it right. If it doesn't balance, it indicates that something went wrong. The following accounts come from the ledger of SnowGo Corporation at December 31st, 2022. So you've got a bunch of accounts and they say, prepare a trial balance in good form. Now they didn't give you the net debit or credit balance. You have to know what the normal balance is. Is the normal balance a debit or a normal balance of credit? Let's look at some of these. Equipment, it's an asset account, has a normal debit balance, so that's going to be a debit. Dividends, normal debit balance, that belongs on the debit side. Accounts payable is a liability. Obligation to pay has a normal credit balance. Salaries and wage expense. Expenses are a reduction of equity, has a normal debit balance. Accounts receivable is an asset. Assets have a normal debit balance. Service revenue, it's a revenue account. It increases equity, has a normal credit balance. Common stock, increase in equity, normal credit balance. Salaries and wages payable, liability, normal credit balance. Note payable, obligation, liability, normal credit balance. Utilities expense, reduction of equity, normal debit balance. Prepaid insurance, asset, normal debit balance. Cash, asset, normal debit balance. Here's the trial balance, again, which is a listing, a summary of debit and credits, and you posted based upon the normal balance. They got it right. Debits equal credits. Compare the procedures for recording process under GAAP and IFRS. We're not going to cover that. So there we go. We can stop sharing this. And again, that's probably the most important material of the course, understanding debits and credits. So the key is to do what? Understand the transaction. Prepare a journal entry where debits equal credits. Post to the T accounts. At the end of the accounting period, you summarize the debits and credits and a trial balance. there we go. We'll see some homework problems that hopefully get you taken care of here. Thank you.